Look at this gap. Sales and production stayed near records in August, while the jobless rate ticked higher in October. That pairing rarely lasts. It marks a system under strain. Watch the context. Industrial output still hovered around 103 on August updates. Equity indexes pressed up into late October. Meanwhile, unemployment rounded up near 4.4 in October. That's a contradiction the cycle rarely forgives. Check the mechanism. When profits hold, stocks can levitate. When hiring cools, the real economy slows. The longer that split runs, the harsher the catch-up. The result? Pressure builds in funding and payrolls first. Notice the bridge. Three forces are colliding: slower hiring, concentrated profits, and heavy refinancing calendars. That's the setup. Look at what happened through late summer. Industrial production, the Fed's index of factory, mining, and utility output, sat just above 103 on August 16th updates. Manufacturing alone printed near 101. Translation: the physical economy still produced near post-pandemic highs. Why it matters: output resilience can mask underlying job stress for months. Watch the timing in labour. Formal payroll reports paused in October during the shutdown, but private trackers and a Federal Reserve estimate put unemployment near 4.4 on November 6th. Planned layoffs spiked into autumn, with technology firms back on offense. Translation: labour softened even as output didn't collapse. That's the pressure point. Check this contradiction in markets. The S&P 500 gained in October, lifting year-to-date returns into mid-teens by month-end. Small caps lagged again after a brief burst in early September. The ratio between equal weight and cap weight S&P fell toward 2003 lows. The math doesn't lie. A narrower leadership carried index levels while breadth weakened. Picture this. A parade looks huge on television when the camera follows the front float. The mechanism works like this. Profits in a handful of giants, especially platform and chip names, offset softness in broad hiring. These firms scale revenue with less incremental headcount. Operating leverage, the way profits rise faster than sales, stays high when costs don't grow with output. Translation: concentrated margins keep indexes up even if jobs don't surge. Follow the money. Capital expenditure on artificial intelligence build-outs ran hot all year. Data centers, power contracts, long-dated equipment orders. But early returns were uneven. An August research sweep said 95% of enterprise generative AI pilots showed no measurable impact on profit and loss. Why it matters. The near-term cash flow lift that could defend payrolls wasn't widespread. The pattern emerged in surveys too. Executives projected about 40% of workforces will need reskilling over the next 3 years as automation spreads. That's an institutional decision, not a social media take. Translation: headcount growth slows while training budgets rise. Think of a factory swapping tools. Production continues, but staffing patterns change. Now, the pressure builds in small business. The Russell 2000 struggled to beat megacaps again in 2025. Managers faced higher rates, slower demand, and mixed AI payoffs. When financing costs rise faster than productivity, the math turns. It's like refinancing a mortgage after rates doubled. Payments jump before income does. Check this contradiction at the policy edge. The Treasury opened November with refunding plans that keep supply steady at the long end while bills expand. The Fed still weighs inflation near target against a cooling labour tape. The constraint is simple. Fiscal deficits, when government spends more than it collects, keep issuance heavy. Monetary policy, how the Fed sets rates, can't fix structural deficits. The result? Markets test who will fund the gap. Notice the gap in leadership. Platform firms gained share as ad engines and cloud contracts recovered. Chip revenues surged on high-end processors. Yet many constituents inside the major indices ended October down on the year. The signal appeared in breadth statistics and equal weight ratios. Translation: The rally hid stress underneath. Follow what happened in revisions. In September, preliminary benchmark adjustments lopped several 100,000 jobs from prior tallies. That means recent strength was overstated. The mechanism is dull but decisive. Surveys miss, revisions catch up, policy reacts late. Picture the dashboard in a car with a lagging speedometer. Braking decisions come a block too late. The numbers prove a divergence. Output near 103 in August. Unemployment rounding to 4.4 in October estimates. S&P gains near mid-teens year-to-date by October 31st. Small caps trailing for much of the year. That package points to concentrated profits with softer hiring. The result? Fragility hides beneath strong index prints. The mechanism works like this. Cheap debt from 2020 to 2021 carried coupons, the fixed interest rates on bonds, near 2. That paper hits a maturity wall, many debts coming due at once, through mid-decade. Rollover, refinancing old debt with new debt, now costs 4 or 5. Translation: interest expense rises even if sales plateau. That squeezes headcount before dividends. Watch the funding plumbing. Primary dealers, the banks required to bid at Treasury auctions, warehouse more duration when natural buyers step back. Auction tails, when demand is weak, appear when price isn't attractive. Term premium, the extra yield for holding long bonds, rises when investors want more pay for risk. Why it matters. Higher long rates tighten financial conditions even if the Fed pauses. Check the services shift. Automation moves from factories to offices in waves. Early adopters build workflows around models. Others stall. An August snapshot said most pilots failed to move P&L, yet boardrooms still committed bigger budgets into 2026. Translation: investment arrives before clear payback. That's normal for new platforms. The catch is timing. The pattern emerged in headcount choices. Large firms slowed net hiring, froze some roles, and paid up for scarce AI talent. Some leaders announced plans to reduce white-collar positions as tools mature. Small firms trimmed hours and deferred hires. The result? The unemployment rate can rise even as production lines run. History shows a rhyme. In 1998 to 2000, profits clustered in a few sectors, while the broader economy looked fine. Capex surged ahead of proven returns. Then policy tightened into rising long rates, and the air came out. Different technology today. Same financing math. Now the pressure builds on consumer-facing categories. Retail job losses appeared in private tallies for October. Leisure and hospitality slowed after a long catch-up. Healthcare kept adding staff, but it can't offset cyclical services. Translation: the broad economy cools at the edges first. Check this contradiction across policy signals. If the Fed cut once in September while inflation hovered above 3, that would be a growth concern signal. If the Fed holds into year-end as labour softens, that's a credibility defence. Either way, the yield curve, the relationship between short and long rates, steepened off deep inversion. The result? Financing shifts from short stress to long stress. Follow the money into power and chips. Utilities face new load requests for data centres that rival small cities. Lead times on advanced equipment stayed long, yet some jurisdictions delayed projects over power constraints. Translation: production ambitions run into physical bottlenecks. That caps near-term productivity gains. The mechanism works inside equity math. When the index leader earns $1 more with one less hire, margin rises. When the medium firm can't pass costs, margin falls. The index can show strength while the typical firm feels weak. Think of a sports team with 2 superstars and a tired bench. The scoreboard looks fine until the playoffs. The numbers show why the gap matters. A labour market drifting toward mid-4% unemployment. Industrial output near cycle highs as of August updates. Index levels near records into late October. Small caps underperforming over a multi-year window. Bond supply steady while deficits stay large. Translation: profits concentrated, funding needs heavy, hiring fragile. So far, production resilient, jobs softer, markets narrow. Coming up, where the break most likely shows first. Look at credit. Real yield, the interest rate minus inflation, stayed positive across long maturities this fall. Spreads, the gaps between corporate and Treasury rates, remained contained but twitchy after weak auctions. The result? New borrowing stayed pricey, even without a credit event. Picture a business card with a rising minimum payment. Watch the revisions calendar. Benchmark changes in September signalled fewer jobs than thought from 2024 through early 2025. Policy and perception leaned on stronger prints that later vanished. The math doesn't lie. Decisions made on overstated strength feel tight when reality arrives. Check the service's automation edge. Contact centres, basic coding and document work already shifted. Roles don't disappear overnight, they decay on replacement. Translation: attrition does the job cutting that pink slips once did. It's slower, quieter and harder to see in real time. Follow the money into household demand. If job growth slows while interest costs rise, spending bends. Retail softens next, then early cycle manufacturers, healthcare and government hold up late. That's the usual order. History shows another rhyme. In 2007, credit spreads looked calm in spring. By August, funding snapped. Today, spreads weren't screaming into October, yet refinancing calendars are larger. The echo isn't guaranteed, but the setup rhymes. Now the pressure builds at auctions. If term premium rises and foreign reserve managers hesitate, dealers demand more yield. A few basis points at issuance scale to billions on interest outlays. The constraint is simple. The United States must sell what it issues. Buyers set the real price. Notice the gap in policy room. Cutting rates too fast risks currency pressure and commodities. Holding too tight risks labour weakness spreading. Fiscal policy leans expansionary by default, with entitlement growth and interest outlays. Monetary policy can't fix the budget. The result? The curve stays choppy as the system gropes for balance. The mechanism works for corporate America too. Early AI investment boosts capex before revenue. If pilots miss, projects slow. If pilots hit, headcount doesn't surge. Productivity does. Either way, the immediate hiring impulse is small. Translation: the jobless rate can rise even in a profit boom. Watch the timing into winter. Industrial production updates on November 18th will show September momentum or stall. Quarterly refunding details rolled out on November 5th for supply signals. Equity breadth metrics keep flashing narrow leadership after October records. Why it matters? All three calendars converge before year-end. Check this contradiction in sentiment. Bulls cite soft landing odds with inflation near target. Theirs point to hiring drift and revision shocks. The middle path is slower growth with higher long rates than the last decade. The result? Earnings dispersion widens. Indexes can rise while median stocks tread water. Follow the money one last time. Sovereign wealth funds, government investment pools, rebalanced toward hard assets earlier this year. Pension funds discussed raising long bond allocations as curves steepened. Primary dealers pushed for concession at longer maturities. Translation: the system demands more pay to fund time. So far, a calm surface and a noisy engine. Output held up. Jobs wobbled. Markets crowned a few giants. The gap grew. Watch the calendar. November 18th brings the next industrial production print. Early December brings updated private labour reads if the shutdown lingers. Mid-December delivers another Fed meeting. That sequence decides whether the gap narrows gently or snaps. Check the scoreboard before we close. Output still near cycle highs. Unemployment near mid-4s on October estimates. Index levels near records into late October. Breadth narrow, refinancing heavy. That's the whole story in 5 lines. The result? If the gap closes through stronger hiring, the system bends, not breaks. If it closes through falling profits, equities take the hit. If it closes through higher long yields, funding costs do the damage first. The math sets the path, not the headlines. The signal appeared months ago.